Hello there, everyone. Thank you so much for joining us today. I'm Marche, the webinar director at Advice Chaser, and I want to welcome you today. Before we introduce our guest and get started, I need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we are thrilled to bring you this educational presentation. Attendees are muted, but we do encourage you to ask questions using the chat box. And the presenter will answer those queries during or after the webinar today as appropriate. If you ask a question in the chat box, go ahead and leave your phone number as well. If we can't get to your question during the event, we'll make sure someone reaches out to you afterwards. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. Well, Wade, if you can go to the next slide really quickly, and then also one more thing, we're getting a little bit of audio feedback, so if you can put yourself on mute, and then I'll switch to mute when you're talking. Well, I'd love to introduce you to our presenter today. Wade Slom is the president and founder of Sidoxia Capital Management, LLC, which he founded in Newport Beach, California during 2007. Wade has worked in the investment industry since 1993 and has been a media go-to resource as seen on CNBC and ABC News. He has been quoted in the Wall Street Journal, USA Today, New York Times, Dow Jones, Investors Business Daily, Bloomberg, Smart Money, and other media publications. And we're excited to have you back, Wade, and I'm going to go ahead and turn the time over to you.
All right, thank you, Marche. Welcome, everyone, and thank you for taking time out of your busy schedules to discuss a topic that I know everyone loves, and that is taxes. Now, taxes are important for a couple reasons. For starters, tax day is just around the corner, and we also know this is a subject we cannot ignore because, as Benjamin Franklin stated, nothing is certain except for death and taxes. All right. With that out of the way, for those of you that do not know me, I will tell you a little bit about who Wade Slom is. I started my investment in financial planning firm, Sidoxia Capital Management in Newport Beach, about 15 years ago. And for those of you wondering where my company name came from, Sidoxia is derived from the Greek word for optimism. It's even hard for me to believe, but I've been in the industry for over 30 years. And before I started at Sidoxia, I worked in Kansas City for about a decade at a company called American Century Investments, where I managed a $20 billion fund. In addition to industry experience, I also have some fancy educational letters behind my name. I got my MBA from Cornell University, my undergraduate degree from UCLA in economics. I also hold what's called a CFA designation, a Chartered Financial Analyst, which is an investing credential held by less than 2% of advisors. I also carry the CFP certification, which stands for Certified Financial Planner. So we are well equipped to handle financial planning needs in addition to investments. At Sidoxia, we primarily manage money and do financial planning for individuals, but I also manage a hedge fund. We provide retirement plans for businesses as well, for example, 401ks and retirement plans. I also taught numerous investment courses at UC Irvine. And last but not least, I published several books, and I'm a blog editor of Investing Caffeine, If you want to learn more about my background, you can simply Google my name, Wade Sloan. If you want to check out my books, you can head out to Amazon and type in my name. All right. So with that introduction out of the way, let's dive into the meat of our tax presentation by starting with a summary of some key 2023 tax figures. So if you're not itemizing deductions, then you can see the standard deduction for a single individual is $13,850 and $27,700 for married couples who are filing jointly. As you can see from all the tax brackets, the marginal tax rates range from as low as 10% at the low end to 37% at the high end. And as you can see, the tax rates are based on your income. So it's $11,000 at the low end for single filers, all the way up to $693,000 roughly at the high end for married filers. So with all these numbers, the goal is to obviously lower your tax rate. And one way you can do that is by accelerating your expenses and deferring revenues to the extent that you can control these items. Businesses generally have a little more discretion on how they can recognize expenses and revenues, but individuals sometimes have some discretion as well. For example, on the timing of bonuses that you take, you can either take it at the end of the year or the beginning of the year. Some firms allow that, or let's say for home improvements, which we'll talk about later in my presentation. The example of deferring revenue and accelerating expenses is especially relevant if you're anticipating less income in the subsequent year. All right, moving down the chart, it's worth noting if you and your spouse want to make a gift tax-free money to family members or other designated individuals, you can gift up to $34,000 to each individual, and you have a $12.9 million lifetime exclusion. All right, and yeah, the main point of that is you're trying to minimize your exposure to that 40% estate tax and gift tax. All right, next, let's talk about utilizing retirement accounts. We'll start with the traditional IRA, which is basically a win-win for savers. By contributing to your IRA, your individual retirement account, you save on taxes because your contribution lowers your income and therefore lowers your taxes, and B, you're also saving for your personal retirement. So rather than just giving away your money to Uncle Sam, you're putting money in your own pocket and reducing your tax liability. Next, let's talk about the Roth IRA. Under this account, you pay taxes now, not in the future like you do with a traditional, and your money compounds and grows tax-free. The IRS is basically saying they don't care if you pay taxes now under a Roth IRA or you pay taxes in the future under a traditional IRA, as long as the government is able to collect their money. As you're probably aware, a Roth is a good deal if you believe your tax rates in the future are going to be higher than they are today. As far as contribution limits go, taxpayers who contribute to individual retirement accounts can put away an extra $500 starting this year. The limit has been increased to $6,500 plus another $1,000 in catch-up contributions for those 50 and older. This is bittersweet and hits home personally since I'm over 50 and qualify for this catch-up, but let me just grab a Kleenex here. That's that $1,000 catch up is actually the same as last year. So we got an increase in one area and the other parts stayed the same. Worth noting, there are some limitations on contributions to the IRAs and also on the deductibility. So it's a little bit confusing, but on the traditional, there are no income limits. So billionaires, for example, like Donald Trump, they could theoretically contribute to an IRA. The hitch is that they can't deduct it for their taxes. So on the traditional, deductibility for single filers is only allowed for those making less than $78,000. And for married couples, the combined modified adjusted gross income must be less than $129,000. For the Roth, the contributions phase out between $138,000 and $153,000 for single filers, and $218,000 to $228,000 for married couples. Okay, let's switch gears a little bit and take a look at some other retirement account flavors. Most of you are familiar with 401k retirement accounts. The majority of large businesses offer their employees the ability to contribute to a 401k. And as you can see, the contribution limits are quite a bit higher than IRA accounts. Cost of living adjustments will bring the 2023 contribution limits to $22,500, up from $20,500 for 401ks, 403bs, and most 457 plans. And for those not familiar with 403bs and 457bs, these basically are retirement tax advantage retirement accounts for government and nonprofit organization employees. You can also see the $7,500 catch-up contribution limit for those over age 50 is more than 7 times larger than the IRA catch-up limit. The good news is that this was increased, the first increase since 2020, and that brings the total contribution limit to $30,000. It's also important to point out, it's really imperative that you take advantage of the matching contribution that your employer may make. And quite simply, there aren't many free lunches that you'll get in your lifetime that guarantee you 100% return on your investment. But that's exactly what matching does. It's free money. So contribute. If you're not contributing, you're doing yourself a huge disservice. On a side note, you can see I showed one of the new wrinkles in the tax law is that more employers will be required to offer Roth 401k retirement accounts, which is a nice perk for employees, just to give them another option.
We had a question here I wanted to pop in since it has to do with what we just covered. Question is, can you contribute to both a traditional and a Roth IRA at the same time? Is $6,500 max total contributions to both total, or is it different?
Yeah, so I'm going to preface everything I say that you need to contact your tax professional. But what I will say is, yes, I believe that 6,500 is the limit, and you cannot do both the traditional and a Roth at the same time. There are examples where if you're a business owner, you can set up a separate, let's say a SEP IRA account, in addition to let's say at a retirement account, you had like a 401k account with your business. So if you're doing 2 different positions, there are ways that you can contribute to 2 different retirement plans. All right, so I'm gonna focus a little bit more on businesses on this slide. We realize that businesses have a lot more flexibility to contribute more to the employee retirement accounts through matching, profit sharing, employer contributions. So it's important to make sure that you read through your benefit manuals, or if you don't know, just simply call up your human resources department and see how much your employer can contribute to your retirement accounts. Business owners are able to contribute, as you can see, significantly more, all the way up to $265,000, and this can be done through pension plans, cash balance pension plans, and a lot of that, again, you're not going to be able to do through a traditional like 401k account. Also worth noting, you know, a lot of people in this gig economy, they may be 1099 contractors. Even if your employer is not providing you retirement benefits, you can actually create your own retirement plan, things like a solo 401k. So you can tuck away more money for retirement, just like W-2 employees. All right, moving on. Let's now talk about health savings accounts. In order to benefit from an HSA, it must be attached to a high deductible health plan. And high deductible health plan is defined as a health plan with an annual deductible greater than $1,500 for self-only coverage, or $3,000 for family coverage. And the annual out-of-pocket expenses, which includes things like deductibles and co-payments, but not premiums, cannot exceed $7,500 for self-only coverage, or $15,000 for family coverage. So the great thing about HSAs, the important thing to note is that there are no income limits. So this is really a great deal for high income earners. And just for those of you that aren't familiar with HSAs, the way that they generally work is they allow eligible individuals to make deductible contributions that can be withdrawn tax-free for reimbursement of any eligible medical expenses. So, you know, you put money into the account, and then you go visit a doctor, you get prescriptions, and you can take the money out of the account. And a lot of these accounts can be set up on debit cards with banks, where you can, you know, use your HSA account like a credit card. And the beautiful thing about HSAs is that any balance left over in retirement is treated effectively just like a traditional IRA. And so HSAs can also operate as retirement account vehicles. You can see here what the 2023 contribution limits are, and that's $3,850 for individuals and $7,750 for family. All right, we have a few more topics we want to cover before we finish today. So let's talk briefly about tax saving investment strategies. All right, I'll start off by talking about tax loss harvesting. And this is merely the terminology used to describe the sale of investments for a loss in order to lower your tax liability. It's important to point out that any investment should never be sold just for the tax benefits. The primary reason for investments to be sold at a loss should be for fundamental reasons. For example, the company that you're invested in is doing poorly financially. Or let's say you sell an investment for personal reasons. For example, you may need to access some liquidity for home repairs. And you know, all those reasons make sense, but not just for the tax reason. The ideal net loss to realize is $3,000. And the reason that is because that is the maximum amount of losses that can be recognized in any one year. Now, you may have investments that have lost a lot more money. The good news is that any of those losses in excess of 3,000 are not usable in the current year, but can be carried forward to the next year and possibly for many years in the future. So the other area that we want to talk about is wash sales. And essentially what this is selling investment at a loss and then repurchasing it within 30 days before or after the sale. And if or when a wash sale occurs, the ability to use that loss to lower your tax liability is disallowed. So you just need to be aware when you take a loss that you can't repurchase it, immediately after that. So in order to understand the intricacies of a wash sale, we'll just dig a little bit deeper. People are always trying to find loopholes around any tax laws, especially including a wash sale. So let's say, for example, they sell an investment in their personal account for a loss. What some people might try to do is immediately rebuy it in a related party's account, let's say their spouse's account. Well, the IRS doesn't allow that, and you can't recognize that loss in that scenario. Or some people will try to sell an investment at a loss in their taxable account and then rebuy it in their individual retirement account. Again, IRS doesn't allow that. And the same principle applies to options. You can't buy a related option. So if you sold IBM for a loss, you can't buy an IBM option immediately after. Now, there are indexes are more of a gray area because, essentially the argument can be made that an index is sufficiently different from a single investment like a stock. So just keep that in mind. The last matter as it relates to investment strategy that I want to discuss is capital gains. All else equal, we generally prefer to hold investments for longer than 12 months. And the reason that is that we're taxed at a lower long-term capital gains rate, which is usually between 0 and 15%. However, if you hold investments for less than 12 months, taxpayers are forced to generally pay a higher ordinary income tax rates. As mentioned earlier, long-term capital gains rates are usually 0 to 15%, but can be 20% if you earn more than $492,000. And yeah, on the other end of the spectrum, if you earn less than roughly $45,000, there are 0 capital gains. All right, in finishing up our discussion today, we will review a few ways you can take advantage of some new tax laws. I'll start off by talking about the Inflation Reduction Act, or just to make it confusing, since we already talked about IRAs, that's what we're talking about. But starting this year, individuals can benefit from a $1,200 tax credit, and this $1,200, this credit can be recognized every year for energy efficient home improvements. So what am I talking about? Some of these qualifying expenditures include things like energy efficient doors, windows, insulation, air conditioning, heaters, wind, solar, even battery storage. And generally, the credits are given for 30% of the costs, up to that annual $1,200 limit. So you can go around the house and see how you can potentially qualify for that $1,200. The credit for solar improvements is not limited to that $1,200 credit. So for example, if you install a $20,000 solar system, you can receive a 30% credit for that, or $6,000. The other thing that the Inflation Reduction Act introduced, or extended that clean vehicle tax credit. So today, there are more cars now eligible, including Teslas, which previously had been phased out. And also used cars, used electric cars now qualify under certain circumstances. And generally the way the numbers work out is that a $7,500 credit can be applied for new electric cars that cost less than $80,000. And the qualifying used cars, you can receive up to a $4,000 credit. All right, the last area of a new tax law that I want to talk about is the Secure Act 2.0. And the first major change I want to review relates to required minimum distributions. So RMDs are a way for the government to force the collection on a portion of your IRA or other retirement account savings. Because otherwise, a lot of investors, they may not need to access that retirement money, and they would prefer to let their savings grow tax-free. But the IRS and government says, no, 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 you have to take a certain portion of your savings out based on your age. So the good news with the Secure Act 2.0 is the RMD age was increased to age 73 this year. Previously it was 70 and a half in age 20 in 2019 and 72 in 2020. And then as you can see here, that age will increase to 75 in 2033. The other aspect to this is that the $7,500 catch-up will increase in 2025. And there's also a special catch-up in 2025 that will allow to take out at least $10,000 for account holders, retirees in that 60 to 63 year time frame. All right, as mentioned earlier, the Secure Act 2.0 will also require more employers to offer their workers a Roth 401k option. And yeah, as I mentioned, people 50 and older making or no, I didn't mention this. There's another piece to the 2.0 that in 2024, so next year, people age 50 and older that are making a catch-up contribution will be forced to deposit those contributions in a Roth account. So again, this is a way for the government to, I guess, take away that tax benefit, at least, that deferral of the tax benefit. You're going to have to add after-tax dollars to this Roth account. The last point I'll make is that there's some changes in the emergency savings provision. So typically, hardship withdrawals had a penalty. If you got ill and you needed to access money, they would still charge a penalty. And so the good news is that they're getting rid of the penalty, but you'll still have to pay the tax. All right, well, that concludes our discussion today. So I just want to thank everyone again for attending, and I hope you learned a few things about this exciting topic of taxes. And with that, I'll open it up for a few questions.
All right. So we had a question about capital loss or capital gains loss, I guess. Does that mean when you were talking back about that, maybe we want to put that screen up again, that a max of $3,000 can be used in capital loss against capital gains in any given year?
All right, let's see, where were we? What slide was that? Okay, I think this was it. Okay. So I'm sorry, could you rephrase the question? I was looking for the slide.
That's all right. That's all right. So does that mean you are allowed a max of $3,000 to be used in capital loss against capital gains in any given year?
Right. So it's the net loss, which is the key term. So let's just say you lost $50,000 in your combined investments. And let's say that in that same year, you realized $40,000 of gains. So your net loss would be $10,000 because you would apply the $50,000 in losses against the $40,000 in gains. So you have $10,000 in net losses. For that year, you could only recognize $3,000 of those net losses on your tax return. And then that other $7,000 would be applied to the subsequent year. And let's just say the subsequent year that you had $10,000 in net gains. So you could apply those $7,000 in losses that carried forward to those $10,000 in gains, and that would reduce the capital gains to $3,000, the 10 minus the 7.
Couldn't find my mute button to unmute myself. Okay, so do you have to file special papers for that 7,000 loss to carry that forward?
No. Every year when you file your taxes, you get what's called a 1099, and that outlines all your gains and your losses. So if you're doing your taxes personally, you want to calculate and keep track of those carry forwards. If you have a professional accountant like I do, then they're responsible to keep track of it. So yeah, there's no additional paperwork. You just need to keep track of it, and then you can apply those net losses in the subsequent years.
If in a given year you only have capital loss and no gains, do you have to declare them that year, or do you only declare them when you want to use them against a capital gain in the future?
That's a good question. I would refer to a professional on that. My guess is that that you probably could defer those losses. So if you chose not to recognize those losses in future years, I'm not sure exactly why you would do that. But yeah, I think you probably could defer it. But again, I'm not a professional accountant or CPA, so I would ask your professional to answer that.
All right. When you receive annual investment statements for tax reporting, are taxes always to be paid on dividends?
Yeah, I mean, there are qualified dividends and non-qualifying dividends, and the tax rates can be different on that. And then there's, interest or dividends if it's a fund on tax-free municipal bond funds or tax-free municipal bonds. And so the tax treatment is different for those. So yeah, generally the tax rates are different, but you're going to have to pay some tax, whether it's federal or state or both.
All right. So you talked about how Roth is a good decision if you believe that you're likely to have a higher tax rate in the future. Can you talk about why it might not be why you might not have a higher tax rate in the future? Can you talk a little bit about that philosophy there?
Sure. No, that's actually a great question. Because for a lot of people, there's an underlying belief by some people, and I think it's, completely logical. I don't want to get too political, but the facts are the facts. The government has a lot of debt. And some people believe that as the debt continues to grow, tax rates are going to have to increase to pay off the debt. So that's one scenario. And that could very well be true. But for most individuals, let's say you're in your prime earning years, in your 50s and 60s, and you're being highly compensated and you're in the highest tax bracket. So what happens once you reach retirement? You're not making income anymore. You still probably making income off your investments. So what you'll see is people's tax rate will come down significantly once they get into retirement. And so that would be one reason why you wouldn't necessarily want to invest in a Roth, because your tax rate in retirement could be lower than your tax rate when you're working. Now, that other scenario that I outlined previously could be working against that reduction in your retirement tax rate. And so, there's a lot of different scenarios and planning that you can make around that. It really just depends on your personal situation and your beliefs about long-term tax rates.
Here's a good question. Can you talk about Roth 401ks and how they differ from like a Roth IRA?
Yeah, so I don't want to say I'm a professional on Roth 401ks, but I'm not. But essentially the basic principle is when you contribute to your traditional 401k account of your employer, they're taking out the pre-tax dollars and putting it in your account. So it's lowering your income and it's lowering your tax rate. With a Roth 401k, yes, it works precisely like a regular Roth IRA account, in that you're putting in after-tax dollars. So a Roth 401k, you're paying taxes on that income, and your employer is just putting in after-tax dollars for you. So it's kind of just a logistical convenience that they're doing for you.
All right, and then one more question before we end here. Do you know why the 401k contribution limits are so much higher than the traditional and Roth IRA limits?
That's a good question. I don't know the history. I think part of it is just for simplicity purposes. So the traditional IRA is very simple, right? It's you write a check, you deposit into your brokerage account, easy peasy. It's done. So even for my company at Sidoxia Capital Management, we have our own 401k account, and it's more costly. So we have annual costs where a administrator needs to calculate how much can Wade Sloan contribute to his personal account, and how much can I or do I have to contribute to the employees. And there's all kinds of tests and calculations that have to go through it. So it is a costly, more costly vehicle than the traditional IRA. And so I think part of the reason is that. The other reason I would say that the contribution limits it's used as an incentive for employers to create tax savings and retirement savings for their employees. So by establishing a 401k for a business, it incentivizes businesses to provide benefits to their employees. So I think the government made a concerted or it had a defined reasoning behind that to incentivize businesses. And so as a reward for providing those benefits to the employees, we're going to allow the company or the employer to contribute more than a traditional IRA.
All right. Can you do one more follow-up question? We had another follow-up question about the tax brackets in retirement. This question is, I contribute only to a Roth 401k. In what instance would one expect to have a higher tax bracket in retirement?
Well, yeah, I mean, I guess I could put together a scenario where, you know, your investments just do significantly better and that generates more income. But yeah, in general, you know, your income from working and wages is going to be a big portion. I guess there's also a scenario where, you know, we deal with a lot of investors that own real estate, right? So when they retire, that income doesn't necessarily go away, and that income can grow in conjunction with your investments. As they grow, they generate more income. So it would just be a scenario in which other income sources other than wages would be going up, in which case, yeah, you could potentially have a higher, you know, tax rate. And then longer term, if the government increases tax rates, that's another scenario.
Right. So, you know, even if they don't have the same income or a lower income, maybe that the laws change and the taxes are higher just because the taxes are higher.
Exactly.
Yeah, interesting. Well, folks, this is a good one to end on, and I want to thank Wade for being here and thank all of you for being here. Wade, if you want to just flip to the end slide here, we'll just go ahead and close this out. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone that we introduce them to. All you have to do is go to advicechaser.com and click on the link to find an advisor. And we want to thank everyone for being here. And you have a great day. We'll see you at another webinar soon. Goodbye, everyone.
Thank you.